I agree. Definitely interesting. I'm interested in this one for sure. Gonna take a look at it. Why don't we, Ryan, go to our next segment, which I'm calling 5 small cap stocks that are up over 100% year to date. So this is going to be our pull-out segment. This is going to be our clickbait headline saving for the YouTube clip, but I think it's going to be a fun screener. I found some interesting companies and some maybe case studies on when you can find a stock that's a potential hunter bagger or something that could go up by a lot within a year. Obviously, you can't bet on that happening, but these are the ingredients for that sort of outcome. So I did a screener on our friends at FinChat, which we'll talk about more later during this segment. And I had 3 criteria: year-to-date performance greater than 100%. And then I excluded biotech, energy, pharma, and healthcare, basically stuff that I don't understand and stuff that will have some wildly changing price movements. And I didn't want really much pre-revenue stuff. Then I just did market cap between 500 million and $1 billion because I don't want any of the tiny stuff that can just fly around like crazy. And there's about 8 of them. I chose 5 interesting ones. Ryan, you can maybe pull up any sort of charts you want while I'm going here, but we don't really need to. First up, I was very surprised to see this, is Root Insurance. Do you remember this one?
Yes, like vaguely. I thought it was a scam,
No, I guess
if I'm
not.
not mistaken.
It's no, that would be Metro Mile.
Ah,
Which
so what does Root do?
Root is essentially Lemonade, but car insurance focused. So they say we're going to be leaner than the old organizations. We're going to be focused on mobile data. We're going to be focusing on providing a better offering to younger customers. And they're up 416% year to date. Smart car insurance startup, trying to use better analytics. If we look at some of the revenue, I basically can look at their first revenue line item there. You can see why the stock soared, right? Because premiums went nowhere, and then they finally started to gain some momentum, and revenues just absolutely soared. They were right around they were losing money on a net income basis. And people probably worried that, their loss ratios were terrible, blah, 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 blah. People are like, okay, your loss ratios are over 100%. That's an unsustainable insurance operation. Well, that's moved really significantly in the right direction where we're very close to break even now. So people like that, you have soaring revenue along with expenses getting better. And if you look at that stock chart, Ryan, I got totally bombed out. And it went from trading at a price to book value this year below 1, and today now it trades at a price to book value above 5. So I think it's a good lesson in a stock going from very undervalued to overvalued that you can get in the small cap world. You have something that the narrative was terrible on it. Like if we looked at that, we'd be like, it's one of those SPAC insure tech companies, just nothing. I don't want anything to do with this. Second, it was unprofitable and switched to break even, which is a huge difference for people that are, thinking that the company might be distressed. And second, the starting valuation was quite low right before growth started to accelerate. Quite interesting.
Yeah, I've looked at a number of companies where they they need to get to profitability, and you're kind of questioning whether or not they're going to be able to do it. And especially if you don't know the company super well and you're kind of just looking at it from the outside in and maybe looking at like the trailing profit margins and all that, it's easy to pass on it. But if they can make that switch and not kill the business in the process, it can lead to completely outsized returns. You see it with Root. I mean, they haven't officially made that switch yet, but they're certainly getting there. Would you touch this?
I don't know. I think right now, probably not, because it's gone from undervalued to probably overvalued, and the price to book is above 5 for an insurance company that hasn't proven it can be that profitable. And I'm not sure how much they can grow, and I'm not sure how much, if they start growing, the legacy operators can come after them. But I did read a fantastic Substack back in before I think it was right after the Q4 earnings, when the stock started to take on this move and go up 400%. This guy wrote up, and I'm sorry I can't remember his name, but if anyone wants it, DM us or whatever, we'll put out the link to that. He basically said, look, This is a distressed stock. The market cap's super cheap. It's trading at a discount to what if they had some consistent loss ratios that were as good as the legacy guys. They're trading at a discount to what their premiums are of what a typical car insurer is. They're starting to grow again, and it's so cheap that he said it was, and people probably laughed at him at the time. And he even wrote in this article, or sorry, I don't know if it's who it is. It was an anonymous account. They said people are going to laugh and say I'm too optimistic, but this is the potential of a 100-bagger. You get 10x growth from the multiple expansion, and then you can get 10x growth from fundamental growth. And it looks like so far they're really on that track because it's up 400%. So we got that multiple expansion within a year.
Yeah, I totally agree. Yeah, people look at 100-baggers and they think they were these bulletproof investments, but you
got to start out distressed.
Majority of 100-baggers, yeah, they came at a super cheap multiple. You look at NVR, who is kind of one of the iconic multi-baggers. Norbert Liu wrote them up. They were coming out of bankruptcy.
Yeah.
And then they had this new model that where it was like the land option agreements, and people thought that was going to help them like reinvent their business. Or that's what Norbert Liu was pitching. I'm sure people just shrugged it off like, okay, this is a bankrupt shitco. Good luck with that.
Yeah. All right. Stock number 2, Sezzle, which is a tough name, I got to say. SEZZLE. Stock is up 315% year to date. Here's what it says they do on their website. Quote, Sezzle is on a mission to financially empower the next generation. Sezzle's payment platform increases the purchasing power for millions of consumers by offering interest-free installment plans at online stores and select in-store location. Sezzle's transparent, inclusive, and seamless payment option allows consumers to take control over their spending, be more responsible, and gain access to financial freedom. So, buy now, pay later, Ryan. And financials, unsurprisingly, when we look at them versus Root, they flipped to profitability this year. So I think there was a huge narrative against these buy now, pay later players. Maybe Sezzle was under the radar. People just tossed him at the bucket, and they've actually flipped to profitability and done maybe a little bit better than the big players. And they began the year at a price to gross profit of just 1.5. So I think the lesson so far this year is if you're searching for stocks that could potentially do quite well, or could be these ones that go from hated at a low valuation to gaining some momentum and being a really good investment, is you want to start with you have to have a thesis of them going from unprofitable to break even, or maybe generating a little bit of profit, because that can change so much from the narrative out there.
Yeah, this one, I guess, buy now, pay later at its core can be a profitable business. I frankly don't see how it's all that different than just a credit card, but if you're able to convince consumers that it's a better proposition and you're able to underwrite successfully, like, you can probably make a lot of money from it. I guess it's more of just like how you can convince consumers.
Yeah, and if we look at them, let me share the screen here. They went into a big drawdown. They're actually still technically in a drawdown if we look at their max chart. So again, it's not the easiest investing to find these stocks, and it makes sense. High risk, high reward. These are, obviously we don't know any of these things. If you dabble into this, definitely make sure you diversify your positions, because a lot of these are going to go to zero. That's the reason that they go up so much, is that they're priced for zero. But we have a small market cap, $500 million today. And I want to look at the operating income here, because essentially, why don't we just do quarterly to even it out? If we look, they were unprofitable, and they've inched their way to profitability. Last quarter, 19 million. I mean, looks pretty good to me, right? But the thing is, for me, I can't really get confidence in the what you call it, Ryan, like anything around buy now, pay later. I have no confidence in any sort of durability in this business, where Root, maybe there's a potential there, but that's an existing operation and they're hoping to improve on it. Or sorry, an existing sector, car insurance, that they're hoping to improve on, where buy now, pay later is almost a whole new category that they're trying to disrupt entirely, a legacy system, which to a point, maybe Root is trying to disrupt them, but I think it's a little bit different. And yeah, we see
Yeah.
today it went from a PE of quite low, and they were barely earning any money, to a PE of 40 today. And why don't we talk about, before we move on, our friends at FinChat? Ryan, do you want to give the little pitch there for our mid-roll ad?
Yeah, I mean, this is one that we shamelessly promote all throughout the shows because we actually use it all the time, and it's kind of just embedded as a part of my research process nowadays. So, if you have checked out FinChat, if you want to check out FinChat, you can get all your segments, KPIs. You can get a complete research platform there. And if you're interested in any paid plans, first of all, you get 2 weeks free. So try it out. If you end up liking it, you can use finchat.io/chitchat to get 15% off any paid plan. So go ahead, check it out. It's finchat.io/chitchat. I also want to take a second to mention our friends at Public again. Earlier in the show, you heard us talk about the investing platform, public.com. That is where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public. Investing options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. Brett, before we get to the remainder of your list, I do want to take a sec to answer some questions here because I think it's good to kind of sprinkle these in throughout. Tyler asks, how would you define your circle of competence? What industries do you feel you know well?
Consumer goods, except for maybe apparel, but there's certain things within consumer goods I like. I think I can understand industrials fairly well, and financials. That seems to be what I like to write about. I might be forgetting some stuff. I know that consumer internet gets tossed in with technology, but basically anything that the consumer interacts with technology as well, I think I can understand fairly well. And if we look at my portfolio, that's kind of how it plays. Financials, industrials, and consumer. Anything consumer. What about you, Ryan? I'm assuming it's similar.
Yeah. I wouldn't say I like thrive in any specific industry. Like I feel like I have an edge over everyone, but I know where I don't have an edge. Biotech would certainly be one. Um, Insurance I struggle with. I just have it's really a different type of business to analyze financially. Um, so insurance, biotechs, trying to think of the other one. Software, I think, as a category, I like. It's fairly understandable. Like you said, consumer goods, anything that's consumer technology, I feel comfortable with. I'm probably forgetting something.
There's
Financials are easy.
pharmaceuticals and healthcare.
Yeah, anything pharma, anything healthcare. It's just something I haven't really taken a deep look at. Anything come like oil and gas, it's just a pass for me every time, frankly. And maybe maybe that's the opportunity for all the oil and gas investors. Um, but yeah, I tend to write off certain categories pretty quick. Financials, they can be a little more intimidating, but once you understand the metrics, it seems like pretty uniform throughout. You can get a pretty good understanding, especially with banks. You just got to understand, where's the money coming from? Where is it going? What do you think of those two categories? And do you trust management? So I think those are probably the categories I like the most. Do you want to keep going with your small caps here?
Sure. All right. Number 3, NuScale Power Corporation, up 248% year to date. They are a leader, well, quote unquote leader, in small modular reactors. And it looks like this is something around the AI, electrification, and energy increase play for the United States. Company's basically pre-revenue, barely generating any, and they're burning a lot of cash. Valuing this one is obviously difficult, but if you look at the narrative around energy usage with all this AI stuff, where they're projecting that electricity and energy usage is going to grow in the United States for the first time in a few decades, well, maybe they're going to need more nuclear reactors, and NuScale could be one that provides that. But this is not one that really excites me. It's kind of just, I don't know, if you could predict there's going to be a AI narrative that translates to a second order effect on Energy and electricity and the utilities, maybe you could have bet on this one, but it just looks like a shot in the dark, and this could just be a short squeeze and people playing around with it. I didn't get too excited by this one at all.
Yeah, this does not excite me. I mean,
Okay,
it's
next one
a
then.
$900
Oh,
million
go ahead.
company and whatever, like $15 million in revenue.
Yeah. Let's see. We have a question here from Tyler. Says, do you guys think coal or natural gas might make a comeback given AI energy needs? Maybe, but I don't know what AI demand is going to be in 3 years, so I would not want to make that bet. A second order effect bet on something that I have no knowledge about doesn't make sense to me.
Agreed.
All
Agreed.
right, this next one is going to excite you, Ryan. I think it's called the Real Brokerage, up 179% year to date. Here's what it says they do. The Real Brokerage is revolutionizing the residential real estate industry by pairing best-in-class technology with the trusted guidance of an agent. We provide a digital brokerage platform for agents while working to build a better end-to-end home buying experience for consumers. Up 823% since 2020, revenue growing 119% year over year since June 2021. And price to gross profit is still, I said just 10.5. It's right around 10, which isn't crazy expensive for a growth company, but also not crazy cheap. Is this a legit compounder, Ryan? Did we maybe discover something interesting?
Potentially. It's something I got to look at way deeper, but just off the top of your head, would you know what metric to kind of use here? Gross profit, would that kind of be
Gross
the big
profit makes
indicator?
sense. Yeah, it looks like they're not any sort of weird insurance thing, or seems like a standard software business.
Um, then gross profit has grown at a compound annual growth rate of 161%. So, yeah, this might be kind of an early stage compounder. Is this the one of the five? I guess you're going to talk about one more here. Would you say this is the one that has you the most intrigued?
Yeah, because Root, I get why it worked, but I don't have any confidence in those SPAC management teams, and insurance startups are risky. Although I get why it worked this year. I get that was an interesting play, and it's just so overvalued right now. Or I shouldn't say overvalued. The expectations embedded in the stock price are much, much higher for growth than they were at the start of the year just because it's up 400 and something percent. But let's move to the last one, FTAI infrastructure. I can see Ryan already rolling his eyes. We got another AI play here, up 139% year to date. I'll do another quote from their investor relations page. The company primarily invests in critical infrastructure with high barriers to entry across the rail, ports, and terminals and power and gas sectors that, on a combined basis, generate strong and stable cash flows with the potential for earnings growth and asset appreciation. And it is an affiliate of Fortress Investment Group, a leading diversified global investment firm. So I think it might be similar to a Brookfield entity where they spin off different segments and you can publicly invest in whatever you want. It looks like this is another infrastructure AI play. They even put it into the title. They've had steady quarterly revenue growth, but this thing trades at 12 times gross profit as an industrial type thing, as an infrastructure thing. I don't think this one interests me whatsoever. And I worry that people are getting ahead of their skis with these kind of infrastructure reshoring plus AI energy needs, and you're going to bid up a stock 140% because of that. Do you have any confidence in what the actual number for energy and electricity generation is going to be in 3 years? What if we see huge efficiency gains on the chips and stuff like that? Whatever. That's that's a little bit of a ramble here. Ryan, what do you think looking at this one?
AI beneficiary play, I will pass.
Thumbs down.
Yeah, it's going to be a thumbs. It's, what do they say on Shark Tank? For that reason, I'm out.
For that reason, I'm out. Yeah. Well, I think that's a good little segment there. Again, check out finchat.io/chitchat. Get a little discount on any paid plan. And if you use our code, don't worry, you're not just getting a discount. It helps us out growing our business as well. Ryan, any final thoughts looking at these small caps? Because I think there's some lessons here, but curious what your thoughts were.
I guess it kind of cemented my belief that like you got to be extra picky in small caps because I mean, you presented five. I thought four were generally not that attractive, and one was potentially more attractive in the Real Brokerage. So definitely got to be extra choosy. I do like this question from Tyler though. He says, I mean, we've talked a lot about micro caps and small caps today. So he kind of asked, do you think micro cap might be harder than large cap because you are buying your shares from informed retail investors